Hi everyone and welcome to episode 93 of the Rewarding Property Decisions podcast. So the Melbourne property market's certainly well underway now for 2025. We've just passed the Labor Day long weekend, which is the first barrier for us to get through, and we're now heading towards the school holidays and Easter in April. So things get away really quickly. The signs have been quite positive for the start of the year. There's been some pretty good activity around. Prices are still fairly stable. There's been some strong results in certain areas. We've seen some auctions that have been really, really competitive and seen prices well above the initial quote, but then we've seen plenty of others too that have passed in and negotiated either afterwards on the day or perhaps the following week. But other thing that we've probably really noticed as well is that we've started to see, from a business perspective, a few inquiries from interstate investors who are quite curious about what's happening in Melbourne at the moment and whether or not there's perhaps some good opportunities to be had and to take advantage of. And they're also, I guess, wondering whether or not perhaps there's going to be any further drops in prices that they might be able to look into. So it's meant that we've been having a lot of discussions with buyers around trying to time the market and looking at whether or not that's something that they should be focused on, or whether or not it's more a case of just get in and let the time in the market be a key component for what is going to be a success in terms of investing in property. So I thought today might be a good opportunity for us to expand on that a little bit further and have a bit more of a discussion around timing the market versus time in the market. So let's get into it. Timing the market is very much around when to buy. And it's very much around a buyer's mindset being, I want to take advantage of things being perhaps a little bit lower. And it's with a focus really of price being the key component to the success. So if I can buy this property at a lower price point and get into the market now, then I'm going to put myself in a really strong position from an investment perspective. They will take into account things like, is the market going to rise or fall? And should I buy now to either take advantage of that, or perhaps should I wait to wait till the market comes back a little bit further? But the most important thing I think that we reiterate around trying to time the market is focus predominantly on your own circumstances. So make sure that it's the right time for you, and if it is the right time for you, then that's the first and foremost thing, rather than focusing too much on the market at that point in time. And so people then need to look at, when should I buy and when should I sell? So if we look first at the buying side of things, so when is the best time to buy? The mindset here is, as I said, the price paid is going to be the key to success. I want to buy into a market when it's at its absolute lowest, and I'm going to try and take advantage of depressed market conditions, perhaps even vendors that might really need to sell from financial perspective. And then the other option is that if the market's leaping ahead in leaps and bounds, which we do see from time to time, I'm going to wait. I'll wait until the market cools off before I start to get into the market, and perhaps even starts to go backwards. And then that will be the opportune time for me to get into it. The other thing that they're taking into account when trying to time the market is their own personal circumstances. And generally that ideal is when I'm maximising my income, but I'm minimising my expenses. So if I'm in a position where I've got a really strong income, might have just had a pay rise, and I don't have any dependents or any expenses coming up, then this could be a good time for me to get into the market. So there are a number of issues that need to be considered when taking into account these approaches. And the first one is, as I said before, that waiting for the market to slow down. Now, we've seen this plenty of times over the years where buyers or clients have come in and said, I just want to wait until the market cools off. It's too hot for me at the moment. And more often than not, the market will take months, if not sometimes years, to start to cool down before it actually looks attractive from a buying perspective. And while you're waiting, it's more than likely continuing to rise. So you're waiting for it to slow down and to perhaps come backwards, whereas the market's actually continuing to go up and up. And by the time it does start to slow down, and it might even soften a little bit, but it'll probably only be maybe 5%. Well, from when you were considering buying in the first place to now, it's probably gone up 15, 20, 25%. And that little slight 5% reduction might look great, but in actual fact, if you'd been prepared to compete with the market 6, 12, 18 months earlier, you'd be 15 to 20% further in front now. So trying to time the purchase is not easy. And the other side of that is, more often than not, you're not going to know when the market's reached its bottom until probably 6 months after that's actually occurred. So it's not as simple as just, I'm going to wait till it's at the bottom. There's no red flag that gets raised saying, market's at its bottom, now's the time to buy. The other thing is, from a selection perspective, you tend to find that discretionary vendors, they're not going to choose to sell in a depressed market. So they're going to, if they don't need to sell, they're going to wait until the market's on the rise and starting to, or perhaps even looking towards its peak. That's when they'll look to sell property. So by looking in a depressed or flatter market, you quite often find that the level of supply is a lot lower, but also, and more importantly, the quality of the supply is pretty poor. So you tend to find that you're trying to find a needle in a haystack, and it's hard enough to find really good quality property in the first place, let alone try to find it when the market's poorly supplied. So buyers risk then, and I've seen this plenty of times too in the flatter market, just buying for the sake of buying, because there's not much choice, and what might look good in that market, in a depressed market, in a really good market, there'd be better quality options around and better quality available. So you can run the risk of buying the wrong property in those circumstances as well. Now, the other one is waiting for the right time from a personal perspective. I said before around peak income, minimum expenses, but there's really, from an ideal and a perfect time, you'll tend to find, looking back, that there's never going to be that. There'll always be something that'll pop up from a personal circumstance, and that might be that you're waiting to start a new job, or you are starting a new job and therefore your income isn't guaranteed and you can't get a loan. You might be looking to have children, and then you fantastic, you have success. You then might be going on a holiday, or you might be waiting for an inheritance. There's always going to be something on the horizon that might mean that will be a better time, or I need to wait. Now's not exactly the right time. It is important. The time for yourself, as I said before, is really important, but don't get caught up in perfect versus ideal. So just make sure that you've thought that through. And then finally, and I do like this as a mindset, but I think it's something that people can get caught up in as well. And that is that they feel as though they need to save more to be able to buy a better quality property. And the intention is absolutely right in those circumstances. But if the market's on the move and you're trying to outsave the market, you're going to really struggle. More often than not, it will outpace you. I haven't seen too many circumstances where people have been able to outsave the market that's on the move. You just need to, you don't want to get caught playing catch up in those circumstances. So now if we have a look at the selling side of things and when to sell, and that is certainly something that can be far more targeted. And as an owner, because you own the property, you have got much greater control. So it certainly works better for you in those circumstances. And you can take into account any number of factors and work around those. And that's things like certain times of the year are going to suit certain properties better. So a property might look better in spring, or it might be a property that gets fantastic northern light. So in the winter time with the sun on a lower horizon, it could work better for you. Or you might have fantastic outdoor space, so the warmer months work better for you. Timing can work really well in that regard. Market conditions, there's certain times of the year where the market is better than others. So for instance, in Melbourne, you don't really want to be selling from mid-December, or even probably the start of December through till the end of January in an ideal circumstance, because the market starts to be a little bit more focused on other things. Buyers are looking at holidays and going away rather than focused on buying property. And then the other one, particularly from an investor's point of view, is if you've got a tenant in place, you've got the lease considerations to take into account. And that's things like, am I under a fixed term lease, or do I have a month-to-month lease in place? Is there any time remaining on that lease that needs to be taken into account? And how does the property present? You might have a tenant in there that's fantastic, that's got fantastic furniture that fits really well with your property and makes it look great. And by keeping him in there, rather than having to style a property and spend money on that, you're continuing to generate an income. And if they are on a month-to-month lease, you can then still offer vacant possession with a 60-day settlement period. So there's ways and means to work with it, and that gives you a bit more selection around what you want to do. And the other things that you consider around timing from a selling point of view is how has the market been trending, and are there any expectations for it to move one way or the other going forward? And what that will then do is allow you to choose whether or not perhaps you need to hold off because it's going to be better, or need to get in sooner because it looks as though there might be a dip coming. So these are all things that are worth factoring in when you're making the decision. And they're good things from a timing point of view, but that you do have a lot more control over that when you're selling than when you do when you're buying. Okay, so if we now switch to time in the market, and I think the really key component to time in the market is compound growth. And if you've listened to our podcasts over the last 4 or 5 years, it's a big focus, and compound capital growth is one of the keys to success in investing in property. And it's very much a long-term mindset. So you're looking at buying property to hold and to let that compound growth, that growth on growth effect kick in and really build equity for you with the right property. Rather than, as we said before, when you're focusing more on the actual purchase price, it's more about, I need to buy it for the cheapest price possible. And that will set me up to build equity that way. When in actual fact, that's not what's going to build you equity. It might in the very short term, but longer term, that's not what will get you there. So it leads to what you want by getting into the market is having the market work for you rather than against you. So once you get in, that time in the market, it starts to work in your favor rather than trying to time the market and it's then working against you, particularly if it's, I'll wait until the market slows. Well, it's going to get away from you. And that compound growth effect is the key to financial independence. And that's something that we've spoken about regularly on the podcast, in that having that equity built up by having that compound growth, that growth on growth effect, really helps you to set up for financial independence into the future. And it's a really significant thing because the longer you can hold on to these properties, the greater that growth will be. So that's the reason why I think time in the market is more important than timing the market, because the elements of timing the market that you can control are best once you've owned the property and when you come to sell it. The timing the market and the buying side of things, it's more important to get the asset right and then get into the market and let it do, rather than when is going to be the best time to buy in terms of the market cycle. Okay, so from a case study perspective, I've got a number over the years that we could have worked this through, but we regularly have clients that come into the office with great intentions, wanting to buy. They plan to proceed, and then something jumps up, and so they decide that, look, now's not quite the right time. I'll put it off and I'll come back to you. So I did have a gentleman come and sit down with me a number of years ago now, and we had a fantastic meeting. He was really buoyed and really excited. Actually signed his agreement at our office and paid his administration fee, and off we went. And then a week later, he rang me up and he was quite excited, but also to say that he wasn't going to be able to proceed at this stage because his wife had just fallen pregnant. So they were very happy and really keen to focus on that. We put him on hold, and then 5 years later, I got a phone call and he came back and they've set up a great life, but he was a little bit disappointed because he looked at his numbers and realised that he could still have purchased the property at that point in time. And what we could have bought then was now worth $300,000 more than what it was at the time. So, and he then realised that, look, we bought him something and that's still working really well, but that $300,000 gap over that 5 years is continuing to grow on itself, or would have grown on itself if he'd been in a position to, or he'd had the confidence to buy at that time. And he does look back at it now and say, well, we could have afforded to do that. We should have done that, but we just didn't have the confidence to at that point in time. So I think bringing this all to a head, timing the market is important, but probably more when it's a more controllable element, which is more when you're looking to sell. If you can work it around in a buying side of things, great, but it shouldn't be the main focus when you're coming to buy a property. It should be time in the market. So make sure the time is right for you, and then once you've got the right time for you, then get in and let the market start working for you rather than against you. So that's it. Thanks very much for joining me for episode 93 of the Rewarding Property Decisions podcast. As we said last week, please feel free to share the podcast far and wide with your friends and family, and also now on social media. We'd love to after our great chat with Luke Saville last week, I'd like to keep pushing that forward. So if you are prepared to do that, we'd really appreciate it as well. Otherwise, if you'd like further information, please visit our website, wakeland.com.au. Otherwise, we wish you all the best with your property decisions.